Well, with Congress now on holiday break, are the markets too optimistic that there's still going to be a fiscal cliff deal before that year-end deadline? They've been doing pretty well. Jason Pride, Glenby, Director of Investment Strategy, is with us. Jim Frischling, NewOak Capital President, is with me. Jim, I'm going to start with you. It's over and over, we keep hearing from investment advisors, they're going to get a deal, they're going to get a deal. You've said that we're going to get a deal. What do you say today, Jim?
Well, we are still calling for that, although our confidence is being tested, and Speaker Boehner could not even get enough of his own constituents to support his B plan, which we did think over the weekend the move to potentially raise taxes on even the millionaires was a move in the right direction. President Obama, the move to $400,000, and we started to see a bid-offer spread, meaning there was a room for compromise. But this kind of derails us a little bit, but we're still convinced that, or rather still on the very positive side, that a deal will be struck, if not by the deadline, just after.
Wait, just after? I mean, so it's got to be next week or no deal. Come on.
But again, if they fail to do it, I mean, it becomes really a risk-off scenario. And I think enough business leaders, enough people recognize the dramatic effect of a no deal and no near-term deal that we are still confident that the right things get done. We've seen this movie before, and I've said that. Right. But it has to be at the last moment, because that's how they're going to draw this out. Chests are bumping, positions are being dug in, but our confidence remains that saner heads will prevail.
But you know what, Jason, at the same time, I mean, what you have heard again is, and this is what Jim is echoing again, is we're going to get a deal. But you know what? The timing of this could be a disaster for portfolio managers like yourself, who've got to advise your clients what their moves need to be before the end of the year. And end-of-year tax planning has been a major issue for many investors.
Look, I kind of agree with you, but I don't completely. You know, we look at this deal. We've been saying for quite some time, our base case is there would be some sort of punting of the situation, some sort of deal that would come in, probably in the 11th hour, just like we've seen before, but that there was not an immaterial chance of a slip-up here where we didn't have a deal. So how do you deal with that as an investor? The reality of it is it's not quite that black and white. Investors do not have to decide between just owning stocks on one side or just owning cash on the other side. There are a lot of things out there to buy. There are bonds that you can buy that protect you. Your likelihood of you not getting repaid,
Jason,
because we go over the fiscal cliff, doesn't drop off the cliff.
Let me just interrupt for 2 seconds, and I'm going to get to kind of some ideas, some investment ideas for our viewers. But at the same time, what we have seen, though, look at a stock like Apple. Look at the dividend-selling moves that we've seen in a stock like Apple. Look at companies that are coming in, upping those dividends before the end of the year, saying, all right, here's the cash now before the end of the year. I mean, these are real examples of moves being made before the end of the year. I mean, you understand that, right?
Oh, definitely. This is you know, companies being disciplined and understanding what's likely going to do or what the possibilities are of things coming out in the future. And these are moves that don't necessarily change their prospects or their businesses, that they can, just by moving things across that January 1st deadline, they can change the outcome or the likelihood of outcomes for their shareholders. So they're very disciplined and organized moves in my mind.
Okay, they are, but they're also, again, those last-minute moves, Jim Frischling. And I'm curious, I know that many of your clients have come into your office, Jim, and said, what am I going to do? What do you tell them? Are there sectors that you think could be hurt by this fiscal cliff fiasco, or sectors that you are advising them to buy into?
Well,
the sector that we think could be most materially impacted directly is housing.
In a bad way.
In a bad way. And by the way, there even could be a deal done that still hits housing in terms of the mortgage interest rate reduction, the mortgage, the Debt Relief Act of '07, things that actually will make it maybe less, decrease the enthusiasm, let's say, for home ownership, which, by the way, is on a nice uptick. Housing has been one of the great drivers of this recovery, and we do think either a weak deal or no deal could directly upset that market and really kind of wipe out some of the gains and some of the momentum's in it.
That's really interesting. Okay, so housing could be a negative. And Jason, I know I had to stop you there, but you said that there are other positives that can come out of this, positive advice that you're giving.
Right, well, the situation we're in is one of timeline, very similar to what we went through with the TARP and fiscal stimulus package votes back in 09, 08 time frame. You know, this is something of timing. There's probably going to be a disruption if we hit the fiscal cliff, but at the same time, regulators and legislators will probably end up being forced into a position of having to do something to remedy it at a later point. In order to manage through that, there's ways to both have your cake and eat it here, too. Investments in debt or higher risk debt that are likely not to, you know, the prospects of being repaid are not going to change. investments in high-quality dividend growth companies that are more stable in essence, their business prospects are likely not going to change that much as well.
Right.
They're going to see less fluctuation in this environment.
Yeah,
give away some of that more distant upside, but don't hide in cash and treasuries.
All right, well, I like the advice. I like the warnings. Jason Pride, Jim Frischling, thanks to both of you. Appreciate it.
Thanks.